From New York City, for our viewers worldwide, I'm Katie Greifeld in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, another hot jobs print to force the Fed's hand. It's making it even harder to find the terminal rate, and that's all as corporate borrowers try to time this market. We begin with the big issue, though, an unacceptably strong labor market.
The labor market has not cracked.
A solid labor market.
It is good news for the economy.
This surprise to the upside
is a little disconcerting.
Inflation prospects are still worrisome.
The Fed can't stop until the labor market starts to slow down.
It is bad news because once again, Fed communication has contributed to undue volatility in markets.
The repricing that we have to have.
What you see is stocks are down and bond yields are up.
We're all subject to the data.
Wages are still going up at a very rapid clip.
The services sector continues to be really solid.
The most important determinant for inflation going forward is going to be the services component.
We need to see that wage growth come down.
It's just going to take longer to see the cracks form in the labor market.
Joining us now, Bank of America's Meghan Swiber, CreditSights' Winnie, Cisar, and Jean Tannuzzo of Columbia Threadneedle. Great to have you guys with us. Meghan, I want to start with you because I was listening to Powell on Wednesday, and it seemed like he all but told us that December was going to be a 50 basis points hike. But obviously, we've gotten a big piece of information since then that November was another hot month for jobs. Does that push back the timeline on that transition to a slower pace?
Yeah, Katie, so our base case is still that the Fed delivers a 50 basis point rate hike in December, which will be a slowdown in the extent of hikes that they've delivered over the past couple meetings. And really, this is because they're taking on this risk management approach here. They want to be able to slow the pace of hikes. You know, Powell's been talking quite a bit about preparing the market for this, and you see the market really reflecting those expectations for that 50 basis point hike in December. But Katie, importantly, investors really need to focus here on the destination, not just the journey. And the Fed still has so much work ahead of it, as you said.
Well, talk to us a little bit about that, because Powell did talk about the terminal rate, that it could be higher than previously thought, maybe back in September. What are you thinking?
So our thought on terminal is that it's between 5 and 5 1/4. And we expect the Fed to signal this in the December summary of economic projections. We think that those dots as of end 2023 are going to be moving higher, suggesting to the market that it's just going to be this longer period of time that the Fed will be hiking. We really think that here terminal is going to be very determined by the labor market. That's really the primary thing that the Fed is focused on to gauge whether or not their policy, their tightening policy is actually having any real effects on the economy. And I think today's print really suggests to the market that there's still a ways for the Fed to go. They still need to be hiking. Probably will be doing so at this slower pace because the Fed itself has so much uncertainty right now. But still does have quite a bit of work to get there. And the Fed will signal this message, we think, again in December.
And Jean, before we get to the destination, let's go back to December and the print that we got this morning. Do you think that the Fed can afford to slow down this month?
I think they can. I think it's important to remember how quickly they've gotten to this point, right? We've seen several 75 basis point hikes, and 75 basis point hikes should be considered emergency hikes. They're the Fed admitting that policy was off sides and they need to very quickly get on sides. We are now on sides. We are on the restrictive side of neutral. Rates are still likely to go higher, but can they go higher at a smaller pace? Yes, I think they can, and I agree that 50 basis points is likely in December. I think if you look at this morning's print, I wouldn't make too much of a single number. I think there is resilience, evidence of resilience in the print, but from a bigger picture standpoint, I would look at the beginning of the year, we were adding close to 600,000 jobs a month. Now we're adding upper 200,000 jobs per month, and we expect that to continue to decelerate.
Jean brings up the topic of restrictiveness, and Chair Powell actually spoke to that on Wednesday. Let's take a listen.
For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March.
So, Winnie, Powell himself said that there is considerable uncertainty there about what restrictive actually is. But what is your best guess as to what that actually looks like and how close we are to restrictive territory?
Well, I do agree that we are already in restrictive territory, on kind of the light side of restrictive territory. And now is where the fine tuning comes. And I think this is giving the Fed a bit of air cover to slow its pace of rate hikes, despite the fact that we continue to see pretty good economic data, including that very strong jobs report. And I would also just kind of remind that, their mandate is dual, so it's very focused on the inflation component, and we are continuing to see some signs of inflation coming down. And if we just start to annualize even some of the recent numbers that include some of those really hefty prints, that puts us at a PCE next year of about 3%, which is not too far off the Fed's mandate. So as we look forward into kind of this restrictive policy debate, we also have to realize that just base effects and some of the other natural transitions in the economy are going to help the Fed out a bit.
And so when we talk about restrictive policy, I feel like we should probably be talking about financial conditions. Obviously, the Fed pays a lot of attention to that measure. And Jean, this is where I want to bring you in, because a curious thing has been happening over the past 2 months. Obviously, with this big risk asset rally, we've actually seen some measures of financial conditions ease pretty dramatically over the past month or so. At what point do you think this becomes an issue for the Fed?
Yeah, it's a good point. I still think we're a long way from it becoming an issue. If you look at research from the San Francisco Fed, one of the things they do, I think, very thoughtfully is package financial conditions and short-term interest rates into one measure that reflects sort of an effective or shadow funds rate. And if you look at that combined measure, it indicates that the sort of effective Fed funds rate is in the 6% area as we sit here today. I would say that is a healthy restrictive number. So, even if interest rates come down a little bit, even with credit spreads having done a little bit better, I think those things are healthy and still indicate that financial conditions have tightened a lot, and there's a lot lower growth momentum going into 2023 than where we started this year.
Well, I want to stay on the topic of what broader markets are doing, risk assets in general. And Meghan, this is where I want to bring you in here, because we did talk to Morgan Stanley's Mike Wilson earlier in the week on surveillance, and this was a really interesting quote. The order of operations is very clear. You want to be in cash first, then you want to buy treasuries, long duration, then buy credit, and buy equities last. And Meghan, I know that you look at the rates market. I promise this isn't a question on equities, but where are we in that timeline? Is it the time for long duration now?
Yes, Katie, we believe that now is really the time that investors want to be leaning long duration, particularly at those longer dated tenors. One thing that we've seen evolve over the past couple of weeks or so is that back-end real yields, to focus on the title of the show, indeed, real yields have really been the component of duration that's been rallying quite a bit. One of our key trades for the year ahead into 2023 was actually going long 30-year tips. And we think that this is a really nice opportunity for investors because it allows them to earn positive carry on inflation still coming in quite hot, but at the same time earn that duration return once we begin to see the economy really weaken in depth. And just even in terms of the most recent remote Fed pivot, just even some signs that the Fed is past that very peak Fed hawkishness, we've seen real yields really contract quite a bit here. But leading into 2023, that's still really the trade that we like here is to be long duration, particularly in real yields. Okay,
Meghan, I want to dissect what you said there. The economy weakening in depth. Is that a recession?
Yes. So in what we're expecting next year is a Fed-induced recession. A mild one at that, but still having unemployment raised to about 5.5% by the end of next year. And ultimately, this is what the Fed still needs to do to cool those services components of the inflation basket. Of course, as someone just mentioned, we have seen some moderating pressures on inflation, but that really is still coming from the good side. That had been kind of long expected. What the Fed really needs to be focused on, and what you could hear in Powell's speech earlier this past week, was this focus on the services component of inflation. And that's still what the Fed needs to be after here. And the direct way to do this is a painful message to investors, but it is ultimately to get unemployment higher.
A Fed-induced recession, some painful medicine there. Meghan Swiber, Winnie, Cisar, and Jean Tannuzzo, everyone is sticking with us. Up next, it's the auction block. Amazon highlights a $100 billion month for U.S. IG sales. This is Real Yield on Bloomberg. I'm Katie Greifeld in for Jonathan Farrow. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off in Europe. The region saw its biggest November for issuance on record. Corporates and banks sold over the equivalent of 130 billion euros in new bonds. Over in the U.S., we saw over $22 billion in weekly investment-grade sales. Amazon, of course, was the big highlight when it sold more than $8 billion in 5 parts. And when looking at the whole month of November, there were more than $100 billion worth of bonds sold. It's the second straight year where November volume has surpassed that level. Over in high yield, though, Oaktree Capital's Armen Panosian sees some opportunities.
Higher quality, high yield bonds offer attractive opportunities. The percentage of BB rated high yield bonds is the highest it's been in 10 years, with about 60% of the market being lightly levered and offering an attractive return, with dollar prices on those instruments in the 70s and 80s.
Still with us, Meghan Swiber, Winnie, Cisar, and Jean Tannuzzo. Winnie, I want to start with you, and I want to pick off where Armen left off. Higher quality, high yield bonds. Do you see the same opportunity?
We do, and we've been talking up the high yield BB complex really for quite some time. So many of these companies are in really solid fundamental shape, great liquidity metrics, great cash on balance sheets. We've done some deleveraging during the pandemic, and most importantly is management teams really focused on capital discipline, focused on potentially IG upgrades. As the cost of borrowing has increased over the course of this year, so has the focus on really defending balance sheets. And we think that it is a very positive thing for the asset class. And when you have BBs yielding, 7, 8, 9% across the curve, that's a pretty attractive opportunity.
Well, you bring up balance sheets, and I want to focus on that because earlier this week we had BlackRock's Gargi Chowdhury weighing in on the looming recession, and she said that this is not a balance sheet recession. This isn't a recession that's coming up because of excesses in leverages. We're going to slow down. We're going to have a higher unemployment rate, but this isn't going to be one where credit spreads blow out to levels seen in deeper previous recessions. And Meghan, I want to come to you just on the recession part of that. Do you think that really this is going to be that type of recession where balance sheets are going to be okay? Corporate America is going to be largely fine, like you say, as a Fed-induced recession?
Yes, Katie, I think that that's generally what we're also anticipating. As was highlighted, these excess imbalances that you generally see lead into some of the deepest, darkest recessions are really not prevalent at this point, which is why we think that, again, this will be a little bit more of this mild recession. The Fed itself is forecasting a move higher in the unemployment rate. That's ultimately going to require these negative payrolls prints that certainly we are still very far away from at this point. But this is still ultimately what they need to engineer. It's still this imbalance in the labor market that the Fed has to be correcting here. But in general, we don't think that there are these significant imbalances that would drive this very deep recession and likely kind of have that massive impact that we've seen, following COVID, post the GFC as well.
And Jean, let's build on that. If that's the sort of recession that we're heading into, what happens to spreads there? Gargi, of course, of the view that we're not going to blow out to past levels, maybe 1,000 basis points on high yield debt. What's your view?
I think it's hard to say with confidence what the peak level of spreads will be. Business cycles don't just die of natural causes. There's some catalyst that causes them to end. And you tend to have two components that happen. First is you have an economy that's operating at full capacity. I would say we largely can check those boxes. But then what that shock will be is unclear. We can certainly point to the Fed, but likely there'll be some other measure of vulnerability that causes the cookie to crumble. So we think spreads can go wider. They certainly don't have to go to 1,000 basis points in high yield or 200 basis points in investment grade, like our very typical recessionary measures. But they certainly could. And I think the thing you can do to protect yourself is focus on those companies, those industries, those cash flows that are going to be more stable, even in an environment where you are going to see some payroll losses, for example, or start to see some loss in aggregate demand.
Jean, where are those sort of stable cash flow companies? Are you talking IG here, or are you maybe looking at some of those high quality, high yield bonds as well?
We prefer investment grade versus high yield right now. I think, double Bs, there are some high quality companies there, but the valuation has really compressed relative to triple Bs at this stage. So we would look at the triple B universe, and one of the previous audio clips you played highlighted low dollar prices in double Bs. But if you like low dollar prices, actually long maturity investment grade bonds are even lower in most cases. So I think the dollar price protection is there. And you've had a double-digit loss this year in investment-grade assets, particularly at the long end. Everything has turned into an interest rate volatility trade. But if we see interest rate volatility start to become more muted, which I think you will, and you have a universe of investment-grade companies, particularly some of the less cyclical industries like banks and utilities, we think those bonds can do exceptionally well in a lower vol environment, even with some economic volatility.
Well, Jean, that's what I've been trying to square. When you see all this money coming into the long end of the market, that's really a call on interest rate volatility. It sounds like you're saying that maybe it's time to lean into the long end if really we are maybe at peak interest rate volatility.
I agree with that. I think, if you look at where we've come from, a year ago, the Fed's own forecasts called for the end of 22 Fed funds rate to be 0.3%. And as we approach the end of 2022, we can see that those forecasts have changed and reality is different than that. So we've repriced a lot. I think given that repricing and the fact that we do have, and Powell even mentioned it in his speech this week, tangible signs of the inflation starting to decelerate, I think it sets a really good stage for a long end duration, and particularly long end high quality cash flows like investment grade and also like, frankly, agency mortgage-backed securities.
Meghan, where do you fall on that question? Are we past peak rate volatility?
Yes, I think that is a fair assessment here. The market for all of 2022 really had been trading on uncertainty around where the Fed terminal rate would be headed. And that was really driven by just a lot of uncertainty and volatility in the underlying data. The Fed needs to be data dependent. And now that we've kind of gotten to this point where we're likely seeing more certainty around what the forward inflation trajectory will look like, we are seeing some signs of cooling in the labor market, not necessarily from today's print, but certainly just in terms of headlines around job losses. We're now past this peak in Fed hawkishness. We're past this level of peak uncertainty around just how high will terminal go. And I think that now that we're moving past that point and into this regime around, okay, the market now has more confidence on where terminal will be, looking at where some of these longer tenor rate levels are at this point really are very attractive levels for investors and I think mark a great opportunity.
And Winnie, definitely, if we are indeed past the peak in rate volatility, that would be good news for spreads. But I want to go back to you on the topic of IG versus junk bonds and what the better relative value play is here. What's your opinion?
I think that this is a really tricky one, and there's going to be so much idiosyncratic risk driving the next 12 months that it's almost hard to say, hey, prefer IG over high yield or high yield over IG. Now, the big theme of this year is that duration risk has been the #1 most damaging thing to credit portfolios. And if it is true that rates market volatility is coming down, we're closer to the Fed's terminal rate, then longer IG positions relative to high yield seems to make a lot of sense tactically. The big question that I have in my mind is, if we are heading into a slowdown, what does that ultimately look like? Do we feel like we're in a stagflation slowdown, or do we actually get a hard landing? If you're in the hard landing camp, you should be buying long end IG all day long. If you're in a more stagflation type camp, then you don't want to be extending duration so much, and you still want to be a bit up in quality. But actually, some of the high yield kind of front dated bonds make a lot of sense there, because we do anticipate that investors will allow those liquidity needs to be met and refinancing actually to occur.
Meghan Swiber, Winnie, Cisar, and Jean Tannuzzo, everyone is sticking with us. Still ahead, it's the final spread, the week ahead, featuring a host of economic data ahead of the last rate decision of this year. This is Real Yield on Bloomberg. I'm Katie Greifeld in for Jonathan Farrow. This is Bloomberg Real Yield. Time now for the final spread, the week ahead. Coming up, PMI data out of the US, Europe, and China on Monday. Then we get rate decisions out of Australia on Tuesday and from India on Wednesday. Plus, US initial jobless claims on Thursday, followed by ECB President Lagarde. Then we round out the week with US PPI and the UMich Consumer Sentiment Survey. But first, it's time now for the rapid fire round. 3 questions, 3 quick answers. Winnie, I want to start with you. This month's Fed meeting, 50 or 75?
50.
Jean?
50.
Meghan?
50.
Okay, Winnie, back to you. Do 2-year Treasury yields hit 5% in the year ahead?
No.
Meghan?
No.
Jean?
Yes.
Okay, final question. Winnie, are we past peak U.S. inflation?
Yes.
Meghan?
Yes.
Jean?
Yes.
Okay, you heard it here first. Meghan Swiber, Winnie Cisar, and Jean Tannuzzo, thank you all so much for joining us. From New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.